Silver just reclaimed $80. And at the same time, the US jobs market just flashed a warning most people only notice after it's too late. This is not a hype video. This is a mechanics video. Because when employment rolls over, three things move fast: policy, the dollar, and forced selling. And silver lives right at the intersection of all three. So here's the promise. In the next few minutes, I'll show you what this $80 reclaim actually means, what a jobs collapse can trigger across markets, and the simple battle plan you can use whether you're a trader, a long-term holder, or you're just trying not to get blindsided. Quick reminder, I'm not your financial advisor. This is education, not a recommendation. All right, let's map the moment. Why $80 is a pressure gauge, not a trophy. A round number like $80 isn't special because it's high. It's special because it changes behavior. Above big handles, liquidity gets thinner, stops get closer, options hedging gets more aggressive, and the crowd stops thinking in probabilities and starts thinking in headlines. So when silver reclaims $80, what you're really seeing is a shift in positioning. It's the market saying, okay, we're not just bouncing, we're challenging the cage. And cages break in two ways: slowly, then suddenly. If you've watched silver for any length of time, you know the pattern. It can drift for weeks, then rip in days, then whipsaw your emotions like a weapon. That's not random. That's structure. Silver is smaller than gold, it's more volatile, and it's traded by people who often use leverage, which means when it moves, it doesn't glide, it snaps. So your first job today is not to celebrate. Your first job is to ask a better question. Is this a reclaim that holds, or a reclaim that gets rejected? Because those are two different worlds. Jobs collapse doesn't look like one number. When people hear jobs collapse, they picture one dramatic print, a huge negative headline, a single moment. But most job markets break like ice. Tiny cracks first, then the surface gives way. So don't just look at one number, look at the rot beneath it. Watch for hours worked shrinking before layoffs hit, temporary jobs fading before full-time jobs fade, revisions quietly deleting strength from prior months, wage growth slowing because bargaining power is dying, participation and multiple job holders rising because one paycheck isn't enough. That combination is how a strong labor market becomes a fragile one, and fragility matters because it traps the Fed. If inflation is still sticky, the Fed wants to stay tight. If jobs are rolling over, the Fed is forced to pivot, so markets immediately start repricing the future. Not next year, this quarter. That repricing is what you're watching today. Two-phase reaction: pivot rally, then liquidity reality. Here's the mistake that gets people hurt. They assume bad jobs, charters, good metals, instantly. Sometimes, yes, but there are two phases to this story. Phase one is the rate cut fantasy. Jobs are weak, so cuts are coming. Yields drop. The dollar softens, metals jump. That's the clean reaction. It feels logical. It feels easy. Phase two is the liquidity reality. If jobs are weak because demand is weak, what breaks next? Credit tightens, stocks wobble, margin calls appear, and suddenly everything gets sold for cash. In phase two, metals can dip too, not because the thesis is wrong, but because leverage is getting erased. This is why silver can rise on fear, and then drop on fear, and then rise again when the dust clears. So when you see silver reclaim $80 into a job shock, you don't just pick a side, you prepare for both paths. Why silver moves differently than gold? Gold is mostly monetary. Silver is monetary plus industrial. That split personality makes silver explosive. On the monetary side, weak jobs can mean easier policy, weaker real rates, and less faith in paper safety. That supports silver. On the industrial side, weak jobs can mean slowing demand, bad for metals. So which one wins? In normal times, industrial demand can dominate. In stress times, the monetary bid takes over. Stress times are when the world stops caring about forecasts and starts caring about certainty. And silver, when it's treated as money again, doesn't move politely. It reprices. That's why the $80 level matters. It's a psychological border where the market asks, are we in a new regime? Now let's talk about the real engine underneath all of this, the dollar. The dollar is the throttle. Silver is priced in dollars, but it is not about dollars. It's about dollar availability. When the dollar weakens because real rates are falling, silver gets oxygen. When the dollar strengthens because funding stress is rising, silver can get punched, temporarily. So today, your key indicator is not your favorite influencer's opinion. It's the dollar's behavior after the initial shock. Ask, Does the dollar fade and stay faded, or does it snap back with violence? If it fades and stays faded, silver has room to build a staircase higher. If it snaps back, prepare for the flush. And here's the hard truth. The flush is not your enemy. Leverage is your enemy. Most people don't lose because they picked wrong. They lose because they sized like the move was guaranteed. So let's talk about sizing and a battle plan. The two paths from here, squeeze or flush. Path A, the squeeze continues. In this path, yields trend down. The dollar stays soft. The market starts pricing a Fed pivot. Silver holds $80 and grinds higher with violent pops. What you'll feel, every dip gets bought. Every breakdown attempt fails. People start chasing, and shorts start feeling pain. Path B, the liquidity flush. In this path, credit stress spreads. Equities crack supports. The dollar spikes from funding demand. Everything sells for cash, including silver, for a window. What you'll feel, whiplash. Fast red candles, and a flood of "it's over" posts. But here's what professionals do in Path B. They watch for exhaustion and reclaim, because the flush is where inventory transfers, from emotional hands to prepared hands. Now, let's make this actionable. A simple battle plan, no hero moves. Rule 1. Separate core from tactical. Core is what you can hold through noise. Tactical is what you can add or trim with a plan. If you mix them, you'll sabotage yourself. Rule 2. Don't chase the first candle. A reclaim is not proven by one spike. It's proven by acceptance. Acceptance looks like this. Price pushes above $80, pulls back, holds, prints a higher low, then pushes again. That sequence tells you buyers are defending. Rule 3. If we flush, buy structure, never emotion. A flush buy is not, it feels cheap. A flush buy is a violent drop, then a failure to make a new low, then a reclaim of the key level. That's the market telling you selling is exhausted. Rule 4. Respect volatility. Silver can move like a blade. If a 5% move against you would wreck your week, you're too big. Rule 5. Keep a checklist. Because in real time, your brain lies. Here's your checklist for the next 72 hours. Does silver close above $80 more than once? Does gold confirm strength, or is it diverging? Does the dollar stay weak, or does it snap higher? Do risk assets stabilize, or do they cascade? Do pullbacks get bought fast, or do they keep bleeding? That's it. Simple. Mechanical. Now let's address the emotional side, because urgent content can make people freeze. Don't panic. Don't freeze. Position. If you're scared right now, that's normal. Markets are engineered to pull you into extremes. FOMO at tops, despair at bottoms. Your edge is not prediction. Your edge is preparation. So if you're new, do the boring things. Tighten expenses, increase your buffer, reduce high-interest debt, then allocate from strength. If you're experienced, do the disciplined things. Define your time frame. Define your invalidation, size appropriately, and execute without drama, because drama is expensive. Now, here's the final point. Silver reclaiming $80 during a job shock is information. It's not a guarantee of a straight line up. It's a sign that the regime might be shifting. And regime shifts are where fortunes are made, and where overconfident people get wrecked. So play it like a pro. Plan first, emotion last, execute calmly. If you want me to keep covering this like a war room, levels, mechanics, and what matters next, subscribe and comment one word below, squeeze or flush. I'll see you in the next update. The jobs report trap, headline versus engine room. Let me slow this down, because this is where most urgent coverage goes wrong. A jobs report is not one thing. It's a bundle of signals that can disagree with each other. So instead of reacting to the headline like a siren, look at the engine room. A, payrolls versus household payrolls can look okay while households show stress. One measures jobs on pay stubs, the other measures people employed. In turning points, the gap matters. B, revisions. The market loves the new number, but the trend is often hidden in revisions. If prior months get revised down, the past was weaker than you were told. C, participation and not in labor force. Unemployment can stay low because people give up searching. So watch participation and the prime age labor force. When the labor pool shrinks, the headline can lie. D, hours worked. Hours are the early warning. Companies cut overtime before they cut people, so shrinking hours can be the first crack. E, wages. Wages are a confidence indicator. When wage growth cools fast, bargaining power is slipping. That feeds into demand, and demand feeds into earnings. Why does this matter for silver? Because the market doesn't trade jobs. It trades the next policy decision, and policy is a reaction function. Jobs weaken, pressure to ease, inflation sticky, pressure to stay tight. When both are true, volatility rises. Volatility is the oxygen of a silver squeeze. What the bond market is really saying. On days like this, everyone watches the metal. Professionals watch the rates market because bonds don't care about vibes. They care about cash flows, risk, and time. If the jobs market deteriorates, the bond market starts sniffing. Slower growth, lower future inflation, and eventually easier policy. That can push yields down. And when yields fall, the opportunity cost of holding metals falls. But there's a catch. If yields fall because the economy is healthy and the Fed is fine-tuning, that's supportive. If yields fall because the economy is breaking and credit is tightening, the first move can still be supportive. And then a funding shock can override it. That's why I keep saying 2 phases. So here's your bond market checklist. Are yields falling smoothly or collapsing in a panic? Are credit spreads widening or staying contained? Are money market rates calm or stressed? Is the yield curve steepening on cuts or inverting harder on fear? You don't need to be a bond trader. You just need to read the weather. Because silver is not just a metal. It's a bet on the weather of money. The $80 options magnet. Why moves get weird near big levels. Now let's talk about the part that makes silver feel possessed. Options. Big round numbers attract big option interest. And when price approaches those numbers, dealers hedge. Hedging can accelerate moves. Here's the simple version. If a lot of calls sit above $80 and price pushes into that zone, dealers may need to buy futures to stay neutral. That buying pushes price higher. Higher price triggers more hedging. That feedback loop is how you get vertical candles. On the flip side, if price fails at $80 and falls back below, hedges can unwind. That can make the drop feel sudden. This is why your plan must be level-based. Don't argue with the tape. Respect the magnet. The question is not what should happen. The question is, what is happening right now? Paper price versus real-world price, where the story gets serious. Here's another truth people learn only during stress. The screen price is the paper price. The real price is what you can actually acquire. During calm periods, the gap is small. During stress, that gap can widen. You see it as premiums rising, delivery delays, smaller bars or coins disappearing first, dealers limiting quantities, call for pricing behavior, and buyers rushing not because they're greedy, but because they're uncertain. If you're a long-term holder, your job is not to predict every tick. Your job is to understand access, because the most painful moment is this. You were right about the trend, but you couldn't get exposure when it mattered. So decide now. Are you playing paper for speed, or physical for certainty, or a mix? There is no perfect. There is only aligned with your goal. The emergency playbook. What to do today. I'm going to give you an exact, boring checklist. If you're trading, identify your time frame. If it's intraday, trade intraday. If it's swing, don't let intraday noise bully you. Define the key level, $80. Above it, bullish bias. Below it, caution. Whipsaw, reduce size. Set a maximum pain number. If the position moves against you by X%, you're out. No debate. Avoid hero leverage. Silver does not reward ego, it punishes it. If you're investing, build a core that you can hold through chaos. If you can't hold it through a 15% drawdown, it's not a core. Add in tranches, not in one emotional click. Small adds at pre-decided zones. That's it. Keep your life buffer first. No metal position is worth a rent emergency. If you're doing nothing yet, learn the process. Decide your vehicle. Wait for structure. There is always another candle. What would confirm a real regime shift? If this is truly a new phase, you'll see a few tells. Silver holds above $80 on multiple daily closes. Pullbacks get bought fast and shallow. Gold is firm, not collapsing. The dollar stops ripping higher on bad news. Risk assets may wobble, but the stress indicators, calm. The big tell is behavior. In a regime shift, bad news stops pushing metals down. It pushes them up. That's when the market stops treating metals like a trade and starts treating them like insurance. The part nobody wants to hear. If the jobs market is truly rolling over, the economy may get uglier before it gets better. That means layoffs can increase, earnings can disappoint, and volatility can rise. So don't build your plan around one clean move. Build your plan around resilience, because the people who win in these cycles are not the loudest. They're the calmest. They plan, they size, they wait for structure, they survive the flush, and then they participate in the squeeze. So here's my closing message. If silver is reclaiming $80 while jobs are deteriorating, the market is sending a signal. It might be a warning. It might be an opportunity. It might be both. But it is not a reason to panic. Plan first, emotion last, execute calmly. If you found this useful, hit subscribe. And tell me in the comments, where are you watching the battle? $80, the dollar, or the jobs trend? I'll see you in the next update. Summed by 60-second scenario grid, save this. Scenario 1, weak jobs, plus weaker dollar, plus stable credit, translation, pivot pressure without panic, playbook, let $80 hold, buy higher lows, keep risk moderate. Scenario 2, weak jobs, plus stronger dollar, plus widening spreads. Translation, funding stress, playbook, expect a flush, wait for reclaim, keep cash for opportunity. Scenario 3, mixed jobs, plus sticky inflation, plus hawkish tone. Translation, higher for longer returns. Playbook, avoid chasing, wait for clearer trend, focus on position sizing. Scenario 4, surprise reacceleration in data. Translation, the market overreacted. Playbook, reduce exposure if $80 fails. Don't fight momentum down. Notice what's missing? Certainty. That's the point. Your job is not to predict the exact print. Your job is to build responses you can execute. If you have to do one thing right now, do this. Write down 3 numbers on paper: the level that proves you right, acceptance above 80, the level that proves you wrong, a clean rejection and lower low, the max loss you're willing to take. If you can't write those 3 things, you're not trading, you're gambling. And if you're investing, write this instead. How much can I buy that I can still sleep with if it drops 15%? That question is a seatbelt. Silver above $80 in a weakening jobs tape is the kind of moment that creates legends and cautionary tales. Be the person who survives it. Keep your plan simple, keep your size sane, and let the market prove itself before you hand it your money.